Yo, TrackFX here. Welcome to another lesson. This one is going to be the final lesson this is going to be the first lesson in stage B, which is IPA, also known as imbalance or insufficient price action. So let's get straight into this. I don't want to talk too much. Let's keep this short and effective as possible. So first of all, what is IPA? IPA, the name itself, stands for insufficient price action. Now, what it is when the market creates a really big move. For example, we all seen those moves in the market where it's insanely huge like that, and then it's followed by another insane move up, right, or an insane move down. When we see these big moves up and down, either bullish or bearish, this to the retail trader is like, damn, that's a big move. But to the institutional traders and the banks, this is considered as a gap. You know, when the market opens with a gap on Sunday, for example, US 30 gap, and then the market has to come back to fill in that gap, imbalances are the exact same thing. When the market creates a big move towards the upside, either bullish or bearish, and there's a ton of momentum, so much momentum, price is technically creating a gap. To the market maker, what they see is just a gap. They don't see candles. They imagine like this wasn't here. Let me highlight this in white, and then boom. Imagine that wasn't there. That's basically what the market maker is seeing, and they basically have to come back down to fill in this gap. That's basically what they're seeing, right? Now, the way we trade it is really simple. Boom. Okay. So the way we trade this is simple. You want to find that last wick. So I'll show you guys a bullish example and a bearish example. You guys want to find that last wick to the next wick. So for example, this is a candle towards the upside, right? After this candle, we're followed by another candle towards the upside. In this case, what we would want to do is we want to find that last wick of the previous candle that went up and draw our zone to the next wick of the candle that went down. So for example, if I take my zone, I would take it from this wick up to this wick right over here. This wick up to this wick. The reason I'm doing this is because this tells me that right over here, from this wick to this wick, price was unfair. If I go down to the smaller time frames, all I will see is simple buying pressure, zero sellers at all. So this is basically where price is unfair, and that's where the name inefficient price action comes in. It's unfair, meaning that sellers and buyers weren't even, and the market makers weren't able to, give you guys a fair buy or ask or bid price for buyers and sellers to come in and buy or sell. Price was simply just moving up so quickly that no buyers were able to get in, and neither were any sellers, and that's why price has to come back down into that imbalance to mitigate it, aka test it. So whenever you do see imbalance like this, let me change this into IPA. When you do see imbalance like that, price basically has to come back down to fill it. Now, one misconception people have is they say that if you see an imbalance, you take your your Fibonacci. Let's take our Fib tool, get the range, and measure the 50%, and you want to enter on the 50% for a buy position. Now, this is completely false. I don't know who said that, who brought it up, but a lot of people think that. I thought that myself, but it's not true. The 50% is a level where the banks and institutions are buying and selling at. It's a median price level, but for imbalances, it's not something you do just to buy. Imbalance is rather a confirmation to find out where is price going to go, because we know where the banks are entering by understanding institutional candles. We know if the market is in an uptrend or downtrend by understanding institutional market structure. We know about liquidity, where the market is going to go to take liquidity. But what about imbalances? We don't know about that. So it's the same thing. We have to find out what imbalances are used for, and that's what I'm going to show you right now. So when you do see imbalance from here to here, price basically has to come back down. So they have to dip price back down into this imbalance. Let's make this red, right? To fill it. Because remember, it's like a gap. To the market, this is a gap. And after you fill it, it's followed by either a continuation towards the downside, depending on structure, or it's just going to continue going up. Because price cannot continue going up if they leave these imbalances in the market. They have to come back and fill it. Now let's go down to the live charts, and I'll show you some real live examples. So right over here on NZUSD, we see this move up, right? We see price creates this major move up towards the upside. We have that expansion, right? Now, in that expansion, what do we see? Let's go to the replay mode right over here. In that expansion, what we're seeing is we see imbalance from this wick right here up to this wick right over here. Let's change this back to IPA. Up to that wick right over there. Now, if you take it from this wick up to like the top wick, you can see that, okay, technically already mitigated it. But if you take it from the next wick down to here, you can see that there's still all this imbalance over here that price has to come back to fill. So inside of this area, this entire zone from this wick to this wick, this is where price is unfair, and the market basically has to come back and mitigate it, or aka test that entirety of the imbalance in order to fill in that gap. So until price is like this, where there's no more imbalance, price will not do anything until it fills that imbalance. So let's see what ends up price doing. So we come back in and we test it a little bit. So we mitigate a little bit of imbalance, but we still have a lot more left. We have this wick to this wick now. And then finally we fully refined it. We fully took out the imbalance to the point where there's no more imbalance. The market tested this big expansion move back up. Now, is there imbalance over here? Well, no, there isn't, because look, there's no clean candle. There's no clean momentumous candle towards the downside. Right over here we have imbalance though. From this wick up to this wick we had a ton of imbalance. Now, we had all this imbalance, but price ended up testing all that IPA and left it just above up to here. So sometimes you will see small little bits of imbalance over here left, but that's completely fine. So right now I'm not explaining what it is. I'm just going to show you guys how to mark it up for the people that don't know how to do that. So we don't really see much imbalance right now, and then boom, right here we do. We see that price created from this wick to this wick some IPA. Well, that means price is going to have to come back down to fill in the IPA, and then boom. Right over here, this is a huge bearish candle where the market created a ton of imbalance from this wick down to this wick. We have all this imbalance, price has to come back to fill. Now price fills it in, but we still have this wick to this wick. Let's see what the market does. And then we fully took out that IPA, and the market, you know, basically did its thing. So this is basically what the market is doing with imbalances. When you do see imbalances in the market, you know, you find imbalance over here, you find imbalance over there, it's basically the market giving you a clue of where it's going to head next. For example, we knew that there's a ton of IPA resting over here. That's why the market made a deep retracement down to completely do what? To completely fill in that imbalance. And after the market, so for example, right over here, if price is right over here, and overall structure, let's see what the structure is. Structure wise, we are moving kind of bearish because we did break structure towards the left or whatever. And I look at the 4-hour time frame, and I notice that there's a ton of imbalance over here, and there's even more imbalance over here, right? And then I know that there's even more imbalance from here to here. I know that the market is eventually going to have to make a move down to fill in that imbalance. So that basically gives me an idea of where banks and institutions are going to be taking price next. Now, we're not going to be using imbalance for entries quite yet. We'll get into that soon. But for now, we're just understanding how to use imbalance and how to mark it up on our charts. So let's play this out a bit, do its thing. And then, boom. Look at this. Clean. Look at this. Clean, clean, clean. Price created a ton of imbalance right over here on the 4-hour time frame. We left imbalance over here. We left, what's the daily time frame? And by the way, imbalance can be found on all the time frame. There's no specific time frame where you can find imbalances. It's on every single time frame, literally. So you can take it from this wick down to this wick right here, right? So we have imbalance up to here, this wick down to this wick. That means price has to come back up to fill it in. Now this is where we can use imbalance for confirmational entries. On the daily time frame, we had all this insufficient price action from this wick down to this wick, and we know price is going to overall have to make it run down to take out all those IPAs that I said on the daily time frame. So we know price is going to have to come back up to fill it up, right? So we'll go to the 4-hour now. Now on the 4-hour time frame wise, we've seen that there's imbalance and price is going to have to come fill it up. But what else do we see? We've seen that price broke a previous higher low. We see this little smaller uptrend happening, and then the market created this higher low, higher high, and then we broke that higher low. And what did I say? I said if you are bearish or you're bullish and you do see that break of structure, what you want to do is you want to highlight that that area where price originally moved down. In this case, this is where price originally moved down. So this is what I'm going to do. I'm going to go down to my 1-hour time frame, and I'm going to find my last institutional up candle before the major move down. In this case, this is my institutional up candle. Now, how do I use imbalance for confirmation? Well, let's go down to the one daily. On the daily time frame, we've seen that price left this insufficient price action, and we know that because we broke structure and price left this institutional candle, we're expecting price to come back up to touch that IC and then go down. But the imbalance that lies right over here, this gives us more confirmation on why price needs to come back up. This gives us an idea of why we want to see price come back up. Now, right over here, and you can see that that's what ended up happening. Price tapped into our area right here perfectly, and then it did its thing. But right over here we have more IPA. We have it from this wick down to this wick, or this wick right here. So that means price has to come back up to mitigate that IC, right? Now we haven't done that quite yet, but we have an idea of why we want to see price come back over here. Now let me delete everything and let me show you how powerful imbalance is. So let's understand liquidity first. We have liquidity right over here, or we had liquidity right over here. Liquidity got taken out. Like I said, if an institutional candle takes or sweeps liquidity, it's much more stronger. This institutional candle did. We have that major last up candle before the move down. Price created this major up candle before this impulsive move down. And what else did it do? Well, it also broke a ton of structure right over here. We have that break of structure towards the downside. We can see that price action was overall moving pretty bullish, and then right away we end up selling off. Now, what do we see now though? We've seen that this institutional candle swept liquidity and then broke structure. So that's two confirmations right there. We swept liquidity and then we broke structure, and then we have an institutional candle right here. So that's about 3 confirmations total we have. 5 confirmations if we take in that, or 4 confirmations if we take in that price action is overall in a downtrend as well. Let's take our Fibonacci, high to the low, level shift, and now we have 5 confirmations, or 6, I'm not even sure. The 88, the 70, and the 70. Price is in our 88th percentile zone, in our blue zone. So that's about 5 to 6 confirmations. What's our 6th confirmation? We have liquidity. Look at this. We have a ton of liquidity just resting above over here. What's our 7th confirmation? Imbalance. Now this is where things get really nice. Imbalance, like I said, it's an overall idea of where price is going to be heading next. We have imbalance right over here, IPA, that did get tested a little bit, but we still tested it up to here, and we still have all this IPA over here. Now this means that price has a reason for why it needs to head up. It has a reason for why we want to see price go back up, because there's money over here resting. 1, 2, we have imbalance, and 3, we have an institutional candle. If we have an imbalance inside of an institutional candle or beside an institutional candle, this increases our institutional candle by a lot. And now look at this. Because we do see that imbalance, we do see that market broke structure, and we are looking to enter on the open of that creation of that expansion. Let's say our entry is right over here, from this open up to this high. Obviously we would refine this, but for now let's just do it like this. Low to the high. Where are we going to target? Well, first off, we can target the next low, which would be right over here, or what we could, we could target the next low. Now, why are we targeting this low? Well, let me show you why. 1, liquidity right over here, that's resting. Liquidity at the lows, boom. What else do we have? We also have imbalance from this wick up to this wick. So now we have a reason for why price has to come back down to fill in this imbalance. And remember, we can't just enter off of because there's an imbalance here, because that's what something people do. They take their long position, they set a limit, and then they enter right away. That's not how it works. All imbalances is telling you where banks are going to take price next. But why is price going to clear the imbalance of the highs first and then take out the lows? Because of this. 1, we're bearish. We're in an overall bearish structure trend right now. 2, price has a reason to go lower because they want to fill in that imbalance later on. If the market takes out liquidity of the lows first and then tests this imbalance and then it goes up, that's more of an idea that the banks want to take price higher. It doesn't necessarily matter which one they do first, but we would rather expect price to take out the liquidity of the highs first and then test this institutional candle and then come down to fill in this imbalance. Now, not only that, but we also check the weekly time frame for imbalance. This also gives us an idea. We can see price possibly come back down to here. We can see price come back down to here. We have all this confirmation of why we can see price, why we want to see price come back down, because they left imbalances. And now look at the weekly time frame. We also left an institutional candle right over here that price is at one point going to have to mitigate. Institutional candles have to get mitigated. They will never just chill here. We have 2 institutional candles, one right over here, a second one right over here, and then we have imbalance beside of our institutional candle. So the imbalance, all it really is just an overall idea of how we want to see price action come into, or where we want to see price action go, and how we want to see it go there. So now we get an overall idea of how we can use imbalance in our trading. But let me show you how we can actually use imbalance inside of our areas of the interest to make it even stronger. So right over here, like you guys saw on the daily time frame, we have our last institutional up candle before the major move down. Now let's go down to the 4-hour time frame and let's look at our institutional candle. Wow, look at this. We have imbalance from this wick to this wick. We have imbalance from this wick to this wick. We have imbalance inside of our area of interest. This entire daily time frame institutional candle has an institutional candle 1. 2, it has a lot of momentum. And 3, it has imbalance inside of it. This creates a more probability and more it basically creates this point of interest a lot more stronger. Now this is how you can use it for entries. We'll get into refining institutional candles into a different video, but for imbalances and entries, it's simple. If you see imbalance inside of your institutional candle, for example, right over here we have 1, we have 2, that means that price is going to have to make a deeper retracement in your institutional candle to fill it up. So now instead of entering on the open right over here with a stop loss at the high for about like 100 pips, we just refined our area from that up to this. We can possibly enter right over here with a stop loss above, right? And I know this still doesn't make any sense. This may be like, okay, wait, like how'd you do that? But we'll get into a different video on refining. Trust me, it'll all make sense. Now we have imbalance right here, right beside our last institutional up candle before the major move down. So what I could simply do is I could refine my area of interest up to here. And guess what? There's also imbalance there. So that means that the market has a reason for why it needs to come back down or come back up into there. Now I can go down to the 3-hour time frame and see if I have more imbalance. And we can clearly see that we have even more imbalance right over here. There's imbalance on every single time frame. It's really simple. There's not much imbalance inside over here now, but yeah, so I hope you guys get an overall idea, a general idea of how imbalances are working in the market. Now let's go back to the 4-hour and let me show you a example of how I use imbalance for a really nice entry. Go to Euro USD. So Euro USD wise, let me delete all this. Structure wise, we're pretty bullish, right? I took this trade yesterday. Structure wise, we're pretty bullish. We have a high, higher low, higher high, higher low, higher high, lower high, low, lower high, lower low. So overall structure now is switching from bullish to bearish. We see price created that break of structure towards the downside. So in my head, I'm thinking, okay, this is a good opportunity to take that sell. From here, I highlighted this institutional candle from the open to the close. That's simple. Now let's go down to the 3-hour time frame and let's look if we have any imbalance. Now look at this. Look how clean this is. We have imbalance right over here from this wick down to this wick. Now, this is where you can use the 50% of an imbalance to refine your entry. If there's imbalance inside of your institutional candle, remember it has to be inside of it, and it's a small zone. For example, this isn't too big, right? This is a pretty decent 17 pip zone. If it's a small zone, you can measure your imbalance with your fib from the high of the imbalance to the low, and you can put your entry at the 50% of the imbalance. That's the only time you can do that. And then the stop loss would obviously go at the close of the institutional candle, right over here or over here, depending on how you trade it. Put it right there. And now look at this. Look at how perfectly price tapped into our imbalance. And where did we target the next low? Where are we targeting? Literally just target the next area where there's imbalance. In this case, we would target the next low over here. But because we're looking to target the next area of imbalance, let's go to the 4-hour time frame and let's try to find it. In this case, there's imbalance right over here. So at this point, we would simply target price right over here. And you can see perfectly it did end up mitigating the imbalance a little bit to the open, but it still didn't fully mitigate it. So that means that our TP is still over here for a 20-1, which is, I'm still holding this trade. It's amazing, really nice, easy trade. But yeah. So we're basically just targeting the next low. Or what you could do is also go for a crazier, TP like all the way down here and target this imbalance. But the reason I wouldn't do that is because overall trend is still towards the upside, right? We still on the higher time frames, like the daily time frame. if we look at Euro USD, obviously it's still moving bullish, right? Well, on the smaller time frame, like the 4 hour, the 1 hour, we did see the opportunity to take a sell. We're gonna have to buys to sells and sells to buys soon, but yeah, so we took that opportunity for that short. So that's generally how imbalances work inside of your point of interest and how we can use it to you know, see where price goes. Now let's go to GBP JPY. GBP JPY, let's go back to a brand new chart up to here, delete everything, boom. GJ. Now let's put everything we did together. So far the trend is up. We know the trend is up. Easily we know the trend is completely up. What we can identify is that there's liquidity right over here that the market has to take out. Let me make a zone instead, it makes it more nice. Boom, we have liquidity over here that the market has to take out, meaning there's stop losses resting below here. Now price needs to go down to take out that liquidity, but why? There's not only liquidity, but there's more. There's imbalance over here. We see this major move towards the upside, and what this does indicate is that price is going to have to come back down to fill in that imbalance. We filled in about 75% of it, so now we have to fill in about this much. We refined it up from this wick to this wick, so now price has to refill this imbalance over here. But we know that because there's liquidity over here and there's more imbalance over here below our liquidity, price is most likely going to make a run below that liquidity and then clean up all that imbalance that it left over. For example, right over here we have imbalance, right? We have imbalance right over here. And if we go down to our area of interest, which would be right here, let's see if there's even more imbalance on the smaller time frame. And look how clean that is. We have this gap, first of all. I don't know why I think it's just the broker, but we have imbalance here to here, and that's inside of our area of interest, or rather right beside it. So we even have more imbalance over here. So we have an overall idea of why we want to see price on GJ fall. That doesn't mean price is bearish. It just means that we have a reason on why we want to see GBP JPY fall back down. And remember, just because we're breaking the lows over here, that doesn't mean we're bearish, because we still have that macro perspective that we have to stick to. The macro perspective is this: we have a low, we have a high, higher low, higher high, higher low, higher high, right? Because if we go down to the weekly time frame, look how clean this is. Let me actually delete all that. On the weekly time frame, it's so clean. It's just 1, 2, 3. Look at this. 1, 2, 3. This is our true higher low. In order for us to be considered to be bearish, we need to break past this level right over here. And that's the only time we're going to be considered to be bearish. But most likely we wouldn't do that. And why? Because overall structure is still bullish. So now we know why we want to see price come back to this daily institutional candle over here. And two, the reason it's going to come back down is because it has imbalance to come back and fill. It has imbalance to come back and take out. We have liquidity over here, right? We have this little equal highs, and then we have this little equal lows, little range over here, forming that the market will have to eventually come back and take out. Now look at this, right over here, we had imbalance that the market ended up leaving. Why did it leave it here? Overall, we're moving higher, right? So look, price created liquidity. Price created a ton of liquidity right here. All right, let me actually change that from here to here. And let's change this from liquidity clear. We had a ton of liquidity over the market needed to clear, and we had our institutional candle. So we know structure is up. We have our expansion zone right here, and we have our institutional candle that broke structure. What else do we have? Well, we have liquidity, which increases the probability of this. And we have imbalance over here, meaning that price has to come back up to do what? To fill in that imbalance. So we have a target. We know that price is going to be going here as a long-term target because it needs to fill in that IPA. And that's what ended up happening. Price cleared that liquidity, pushed up, and cleaned up that imbalance. Now look at this. When the market ended up leaving imbalance over here, what did it do? Right over here, we left a ton of imbalance. Boom, and boom. We had left these two levels of imbalance. What did the market do? After it created a new high, it ended up selling off, correct? Why? Well, it needed to fill in that imbalance, and there was an institutional candle there. Now let's look at what price did now. Right here, what did it do? Same exact thing. The market left imbalance over here that it has to come back to fill out. What's going to happen? Well, most likely price is going to come back down, consolidate a little bit, create liquidity of the lows, test this order block, and then go up. But why? Because there's imbalance over here. There's liquidity over here. Let's go to the 4 hour, right? This is all a range. This is literally all a range. Now, let's go back to the 1 hour time frame right over here. And like I said, we are focusing on, sorry, this is GJ, right? Yeah, we are focusing our area mostly over here. Why? Because, well, there's imbalance, right? and there's an institutional candle on the daily time frame. There's all this reasoning for why GJ has to come back down and fall, because it needs to mitigate this. But remember, we don't take imbalances as something where we use it for a trade trade entry. We're not just entering over here because there's imbalance. No, we're entering because there's an institutional candle over here that we can refine up to here. We're entering because of that. We're not entering because there's imbalance. The imbalance just gives us more confirmation. And someone asked me today, like, okay, how do you know where price is going to go next? Well, the reason I know that is because I know that where imbalance is. For example, right here, I knew there's imbalance, so I said, okay, and price is moving higher. It's in an uptrend. It's going to have to fill in that imbalance eventually. We left imbalance over here, so I know that there's liquidity and the market's going to have to sell off to clean up that IPA, and then from there, it'll continue going up. If I take my Fibonacci zone as well, high to the low, or low to the high, levels fib, you can see that we have our 88, 70, and 78 rejection level or zone level. So we have all these confirmations on why we want to see price go down. And the next confirmation, we have expansion, retracement right here. Let's make this red. And then once again, what do we have? We have expansion. And what did I say about the expansion, retracement, expansion? Price has to come back down to retest the open of that expansion and then continue going higher. So let's write down all of the confirmations now. We have order block. We have institutional market structure. We have liquidity by our side. We have expansion versus retracement. We have imbalance, right? What else do we have? Let's look at the sessions. Let's see, when did this move happen? Let's go down to the 15-minute time frame. This major move that we are seeing up happened in New York and London. Majority of the biggest moves happened in New York and London, right? And Asia didn't do much. It just consolidated. So we have London session by our side as well. So this is a good idea of how you can use imbalance for your entries, how you can use institutional market structure and combine all these things together. Now, I'm trying to make this video extremely short and easy to understand. So I hope this video made a lot of sense. Thank you guys for watching. I'll see you guys in the next one. Peace.